everyone, and welcome back to another episode of the Smart Money Show. My name is Naman Akhtar, and as usual, I'm joined by Ali Sulman. How's things?
I am good. I'm very, very excited. I'm not even going to go on to small talk that much. I'm just very excited about today's episode. Obviously, for our viewers and listeners, it's our 20th episode of the Smart Money Show, and as usual, we bring you bigger and better guests each time, and today is no excuse at all. But before I go into the intro, how are you?
I'm all good. You know, we're enjoying summer.
Yeah.
Like this opportunity to just come up to London, right in the heart of London, and just enjoy filming at different locations, I think is a blessing, isn't it? So, 100%. Of course, as you said, milestone episode. Who do we have today?
For sure. So today, very pleased to say that we are joined by Robert Donald. So he is a capital markets veteran with nearly 4 decades of experience spanning both the sell side and the buy side. Over the course of his career, Robert has held senior investment roles at some of the world's most respected financial institutions. Robert spent the first chapter of his career on the sell side, working in corporate finance, before becoming a top-rated equity research analyst across European sectors. He then moved to the buy side, where over the next 25 years, he built a reputation as a thoughtful and dynamic long-short portfolio manager. His experience includes leading roles at hedge fund giants such as GLG, Soros, and Brummer. At Schroders, Robert led the creation of Helix, a market-neutral, multi-manager hedge fund platform, and also headed up Schroders Gaia, an alternatives platform that hosts global hedge fund names. His approach has always combined sharp market intuition with a deep understanding of risk, portfolio construction, and of course, manager selection. Robert's perspective is grounded in a career that has spanned nearly every major financial event of the last 40 years, from Black Wednesday to the global financial crisis, from the dot-com boom to, of course, COVID and beyond. He has navigated shifting macro regimes with insight, adaptability, and of course, much needed curiosity. So, in today's conversation, we'll explore the lessons, insight, and mindset that come from a career built at the very highest levels of finance and the ideas that continue to drive him forward. So, a very modest intro for a very, very esteemed guest. So, without further ado, very excited to welcome Robert onto the podcast. How are you?
I'm good, thanks, Ali, and thank you for this conversation, but I think we probably should end it there because there's nothing else to add. I felt that was very flattering, so thank you very much. I was worried you're going to say that I had experience back to the 1929 crash. I'm old, but not that old. But thank you.
No, thank you.
How can I help you? Because I have to say from the outset, look, the reason why I'm doing this is that you are a persuasive character. You rang me. You didn't take no for an answer. You were tenacious, but I think ultimately what you're trying to do here is good in terms of educating your peer group and giving them access to people that they might not have access to maybe help their thoughts and stimulate their path forward.
No, it's exactly that, and of course us learning along the way as we are part of our audience. But Naman, I'm going to give you the privilege of asking the first question of the episode. So do you want to get straight into it?
Yeah, of course, 100%, because normally for any episode what we do is that we kind of get a background on who our guest is. So we're going to start off with a few questions on your early career as promised. So what first drew you to the world of finance, and when did you start thinking about markets more?
So I grew up in Scotland, in Glasgow, and when I think back, I came from a family of a mother and 3 sisters. My father unfortunately passed away when I was 3 years old, so I had no exposure to male guidance in my youth. However, my mother was made the chairperson of a family business which was involved in chemicals and trading, and she had some really good advisors and support around her. And one of those people was basically a surrogate father and a mentor, and he is somebody I interacted with, and he was a renowned businessman in the Glasgow community and a stockbroker, and that stimulated my interest. And he had also studied accountancy and went to Harvard where he did an MBA.
Wow.
And he was from a very well-known family in the Glasgow community, and that really sort of gave me a guiding light of probably something that would interest me. I was reflecting the other day about the fact that I probably read my first annual report when I was somewhere between 10 and 12 years old.
Wow.
Because my mother used to receive in the mail, because those were the days where you used to have physical share certificates and registration, and you used to receive in the mail a copy of the accounts from the company that you were invested in or the fund. And there were funds back in those days which still exist today, like Scottish Mortgage. And she would receive annual reports that would just sit there on the side, and I would go and read them in my own time. And I guess that's where I became curious. So I think the mentoring of somebody that helped my mother greatly and provided support to our family, but also reading annual reports, which were, it probably says how boring the rest of the stuff was in the house to read, but nevertheless, it was interesting.
Yeah, I mean, well, it gave you the start to a career, right? Which I'm sure you didn't.
It gave me curiosity. It didn't start my career. It gave me curiosity.
Yeah.
But one thing I did take away from it was that I felt that whatever I want to do, and all my sisters went into doctoring and medicine, and I wasn't good with blood. So I knew that I wanted to go into a non-blood area. And accountancy and finance seemed like the safest option. But the good thing I noticed with accountancy was that it was a great platform to then springboard into whatever career you wanted to do. So that was my intention, which we might come on later what actually happened. But anyway, that was my intention.
Yeah, they say it's a very cliche statement, but accounting being the language of business, but it is true. And what you said about reading annual reports, I think that still stands today, because, you know, when I was going through essays for economics back in A-level, then looking at annual reports does give you a strong understanding for any career path within finance. So,
But maybe we should have started earlier.
In my day, they were much more digestible. They were maybe about 50 pages. Now they're like 500 pages. So there's too many governance rules and ESG requirement rules, etc. But anyway, that's there's no lack of information in an annual accounts today.
Yeah. Well, we like to kick off with a question like that because we think it provides the frame to a picture we're trying to paint throughout the episode. So we're going to fast forward a lot now with this next question. So when you first entered finance, I believe, was that on the sell side? And what was the sell side like when you first entered, and how has it potentially changed over time?
So I started in the mid-80s, and I come from university, and actually I think the university was an interesting experience. So it was, back in those days, there were very few university courses with placements. And I chose to do a business degree with accountancy before knowing which my career path would be, because it had a placement. And back in the early 80s, there was a lot of economic uncertainty, there was a lot of high unemployment, and my mother thought it would be a good idea that I shouldn't just go down a narrow course, which might be great in theory, but have no job opportunity. And I took on board some of her advice, but I wanted to do business, coming back to that early mentoring, but I wanted to do a course with placements. So I did a course with placements, and one of those placements was in the NHS in London, working in the administration side, which was fascinating, which is another story about analysing patient complaints. And then the other area I went and worked in was in a conglomerate in the US, in a M&A role. So that gave me a real interest of the world of corporate finance. So when I then went back to university, I made applications for a number of graduate programs, which were only then beginning to be developed as the norm. And because it was very unusual, normally you went into a very streamlined finance field. You either went into the treasury market, you went into the risk market, you went into equities or market making or broking or research. But this was an opportunity to go to a more diversified institution, which at that stage was called County Bank, which was the investment bank of NatWest, which changed its name many times. So I applied for that course, and I was lucky to get taken in as a graduate on the grad program. And so my first observation going back to then was that there were very few multidisciplined investment banks at that stage where you could land on a course, an internship or graduate program, which would give you access to a whole range of different skill sets, which was unusual at the time, but was a great opportunity. And actually reflecting back on it, they had venture capital as well. So it was everything from corporate finance, venture capital, treasury, corporate credit, etc. So first thing was, back then, it was just when Big Bang was happening. Big Bang is probably something you're not familiar with. but it was a key event in the mid-80s where Thatcher allowed deregulation of the financial markets. Up until then, retail banks, stockbrokers, market makers, and other disciplines in the city were all separate with partnerships. Those rules changed, so they could be then amalgamated, integrated, and then there was the development of the diversified, multidisciplined investment banks. And at the same time, those barriers came down. Then major US institutions came into the London market, whether that be Goldman Sachs or whether it be JP Morgan, etc. They started coming in. So it was a very dynamic environment. So when I started, investment banks as we know them today were very unusual. It was still very much a collection of focused, disciplined partnerships, and that was changing. And that was really the cusp of the big explosion in the city at that time.
Yeah, I mean, because I'm going into application season soon, so and looking at different banks just to see that, like right now, most banks they've got just so many different divisions, like, ranging from your retail all the way to your investment banking. So that's interesting to see how it's changed. But then, of course, the majority of your career was, correct me if I'm wrong, in the buy side, right? So why did you make that change, and was that maybe an opportunistic thing, or was it?
So just to go back, just to add a little bit more to the sell side. So I started in corporate finance. As I said, when I was in the US, I had a real interest in corporate finance. And when I was doing corporate finance, which in itself was very interesting, doing advisory work on M&A or capital raising or IPOs. So those were the days when the government was spinning off publicly owned assets and IPOing them into the market, trying to develop a share ownership class in the culture in the UK. At the same time, it was wanting to raise capital to basically fund the deficit that Thatcher had to be able to fund her economic expansion plans. And whilst that work was exciting and interesting, it was nothing like as interesting as what I observed from the outside, looking at analysts who were making forecasts about companies and giving insights into what companies did and giving advice to clients. So I had this expectation that if I moved to the research side, I'd really get an insight into how corporates worked and how these really clever people would forecast the future. And in part that was because I always had this expectation that I'd go back into business myself at some stage, and this would be great grounding. But also because I wanted to learn the skills of forecasting that these great minds were doing. When I then went into research, I found out that it wasn't quite as sophisticated as I thought. Invariably, the analysts then, before tighter regulations came in, would talk to the companies and ask the companies what they were going to make. And then the company would say in return, well, what do you want me to show? So there was an interesting two-way relationship between the sell-side analysts and the corporate back in those days around what forecasts, what numbers were delivered to the market. And it was a relationship which obviously became too cozy, and there was pushback on that. But nevertheless, it was a cusp of an environment where there was a legacy of analysts who were very qualitatively strong, but not necessarily quantitatively strong. And I was coming in with much more of a quantitative bent, and the American investment banks were coming in with much more of a quantitative approach. And there was a particular institution that NatWest Securities, which had evolved from County Securities, bought, which was Wood Mackenzie, which was a great brand, a really thoughtful research house. And that, brought in a much more professional spreadsheet-based approach to analysing companies. So I was slightly shocked when I first went into research that they weren't doing the hard legwork that I thought they were doing. It was more a relationship of information between them and the corporates. But then it actually did teach you that there was flexibility in the numbers a company can show. So it's not as black and white and as formulaic as your accountancy degree might tell you. There is a degree of art in what numbers companies can show, whether that be through provisioning or whether it be through the timing of revenue recognition, whatever. But that was interesting to get that qualitative insight, but then building my appetite for fundamental quantitative research, I enjoyed the next, whatever that was, 12 years, building spreadsheets, meeting companies, going on the ground, understanding how strategy was put in place, how market shares changed, strategy retaliation, etc. So that puts sort of all the theoretical analysis that you learned in a book into practice, and that was exciting. However, the sell-side model at that stage, and to a large extent today, depended upon analysts having a number one ranking and just persisting with that number one ranking and delivering that status to their institution. And after a while, that becomes a little bit boring or demotivating, just to work hard, just to preserve your status rather than grow. And there comes a point when you feel that you've been number one in your field for long enough, or that it's difficult to marginally increase any further, and you feel that you need to look for the next challenge. And at the same time, the regulatory environment was becoming more restrictive. The relationship between, say, corporate finance and equity research, which was quite an exciting dual relationship where you were giving advice to corporates because of your sell-side perspective and understanding what investors wanted to see, that all got closed down because there was a concern that there was misinformation or market abuse, or however you want to describe it. So the job became much more regulated, became much more formulaic, and I was a little bit tired of just persisting with the number one ranking. I wanted to have a new challenge. So in the early 2000s, the business I was working for was sold to an American entity, and we moved to Canary Wharf, and Canary Wharf is not my favourite place. Sorry for anybody on this call that likes Canary Wharf. And I decided in my mind that I wanted to move on. So I had two choices. One was to get a new challenge on the sell side. The problem was that management in a sell side firm didn't want you to move into a new area of equity research or industry exposure, because they lost that number one ranking, and then suddenly you would go back to number 8 or number 10, and it would take time to build you back up. So they didn't have the same incentive to give you that challenge. And then the buy side firms were very comfortable with you sitting in that seat, providing them with your insights and experience without having the hassle of having to recruit you and hire you. So I decided actually to step away and completely take the risk and leave. So I left without any job to go to, but I knew I wanted to go to the buy side, but in particularly the hedge fund community. And I was fortunate. I had a good relationship with a number of hedge fund firms, and within 5 days of having left and genuinely leaving with no job opportunity, taking that risk, I got an interesting phone call from a partner at GLG, and I went to meet with him, and he said, look, I'm really interested about your experience and how you can help us, but the truth is most of my partners here are used to just hiring traders and not having an analyst-based person in the room. So you're an unusual animal for us. And we got over that, and I joined, and it was a really interesting experience, and I enjoyed working at GLG for nearly 10 years, and it was an exciting firm.
Amazing.
So to answer your question in a long-winded way, it was the fact that the sales side was becoming more regulated, the fact that you'd been in a number one position, and that's all your management wanted from you. So what was there incrementally to do? So I wanted a new challenge, and I felt too young just to stay stuck in that role, and in 10 years, 20 years, just become a boring old whatever in my sector.
Yeah, so the lesson I got from that: constantly be chasing new challenges. Always try and stay on the learning curve. Don't be happy when learning stops. Right?
Yeah. Don't become complacent.
Yeah.
Don't look for a new challenge. Having said that, don't try and change role too often.
Yeah.
Because I think there is a premium for consistency, focus, building a franchise, having proven something, gone through a few cycles. But having said that, once in a while, the opportunities change, and when you see, for example, in my case, the market was becoming quite regulated, quite stifled, I found that demotivating. I wanted to be stimulated. So, in that old financial term of going ahead of where the puck's moving to, I thought it would be much more exciting to go to the buy side, which actually up until then wasn't as dynamic as the sell side was in terms of creativity.
Yeah.
And then there was a lot of creativity, particularly amongst the hedge funds, and that stimulated me. So I was very lucky to have that opportunity. And but yes, you're right. Keep looking for new challenges, but get the timing and get the frequency right. Don't overly change.
Yeah. Yeah, a brilliant lesson. I love what you said there, premium for consistency, because there is, but there's a spectrum of it almost. You don't want to go too far either way.
Because one of my fears is that I'm like deep into my career, and then I realize I'm stagnating. Like, as you said, that we should stay within positions for a few years, develop that, I guess, consistency within that role. But yeah, stagnating is one thing I fear, and possibly many of our viewers.
But if you feel you're stagnating in your role, your first responsibility is to yourself to go and talk to your management about, can you fulfill another challenge within the business?
Yeah.
If you find that there isn't a challenge, or that their incentives are not in line with yours because they want to keep you in that box because that suits their KPIs, then you have to take control of your own destiny and step away.
Yeah.
So I'm not saying you should only look after your own back without talking to people around you. You should, because opportunities can come from inside your business, particularly if you put your hand up to say you're up for a new challenge. So it's on your responsibility to look for challenges internally in your business. But if they're not there and the business is stifling you and stifling management to give that opportunity, then you have to look outside.
I think perfect way to move on to the next section, which is of course about your buy side mindset and sort of hedge fund strategy a little bit. At the top of the episode, in your intro, I said you were a thoughtful and dynamic long short portfolio manager. So why don't you talk to us a little bit about what does being a long short manager actually involve? And I know no 2 days are the same, so just kind of from a broad perspective.
So firstly, long short, what does that mean? It means owning things where you're exposed to the stock as an owner, whereby you want to see it participate and appreciate to reflect what its true value is. And on the other side, you want to short, as in sell, a stock in anticipation of it deteriorating and weakening and disappointing and its stock price going down.
Yeah.
Now, within the long short community, there's lots of versions of that. So you can have long short in different asset classes. It could be corporate credit, it could be in macro assets, or it could be in equities. So my historical focus was on equities. And then when you talk about a long short manager, you can have some which are very directional, which could be 30% net long. So if you give them $100, to give a number, they may have $30 of exposure to the equity market. So they may be, for example, long 100 and short 70. So they've got leverage of 170 or gross of 170. But net exposure of 30. And you may have some managers that are actually long 80 to 90%, which basically means that their performance is very much driven by partly their stock selection, but mainly the behavior of the stock market. I was much more comfortable in the sort of 15 to 30% delta range because I liked the fact that when the market sold off, I was enjoying the benefit of having lots of shorts, which would help dilute the drawdown risk and would give you, in a sell-off in the market, the opportunity to buy great assets cheaper or close down some of your shorts which have performed. But if you're very directional as a long short manager, you're very much dependent upon the tailwinds and the headwinds of the stock market. So there's lots of different ways of defining being a long short manager, but that was the area that I focused on. So equity long short, but predominantly low delta.
Okay, and then so within this field, it's, I guess, to a certain extent, there's a lot of entrepreneurial characteristics that need to be taken into account because, of course, the strategies, you have to come up with strategies yourself. So do you think that your previous experience there, like within other roles, helped towards that, or is that something that you're naturally naturally good at?
I mean, in my case, I think there are people that came to the job back in the day that I was starting at GLG, for example, who were traders. So they had a great feeling for flows in the market, or the animal spirits in the market, or where the oversupply risk was, and they would have an intuitive instinct about stock levels, and they would have high frequency stances. They would trade in and out of things, and they would clip their returns through lots of little price movements. And they were very smart and very good at what they did. In my case, I didn't come with a trading mentality. I came more with a business fundamental view of where I saw earnings growth versus the market being better or worse, and therefore latching onto that opportunity and either being long or short that, or if I saw a misrating opportunity, I thought something would be rated higher or rated lower than it was currently because of that path of earnings, or because there was a misunderstanding of the business model, or that its pricing power wasn't as good as people thought it was. So I came to my stock selection process through fundamentals and direct access to management and understanding what the pipeline of their business looked like over the foreseeable 9 to 12 months. Whilst in the case of the trading community, they came with a different skill set. They were different, but they were compatible. So I think my background in being sell side and getting into the minutiae of a stock helped me. The ironic thing is, in my first few years at GLG, I can remember my first year where I still had good performance. I lost money in the things that I knew the most about. So I'd come as a sell-side analyst in a particular sector, but because I came with so much premeditated or existing bias to those companies, I was short them. They happened to be, a lot of them were home builders, and at the time, the banking industry was being further deregulated to the point that institutions like the Bank of Scotland or Halifax were starting to buy. I mean, they were in the business of giving mortgages, but then they were starting to make acquisitions. They were acquiring home builders because they thought it was part of their vertical integration. We got monies being deposited with us by our retail clients. We're going to issue that out as loans to home buyers as mortgages. Oh, why don't we then home the home builders who are in the food chain of the mortgages? So they got involved in that, which was irrational, and they paid ridiculously high prices. I was short those names because I thought they were being mispriced and they were fundamentally incorrectly priced in the market. But I was wrong because they got taken out. Fortunately, I made money in lots of other things that I was the other way on. But sometimes knowing too much about something can be also a weakness.
Yes, and just as you kind of alluded to, looking at sort of the buy side versus sell side is kind of what we're trying to paint this as. How did you think, and potentially maybe speaking on behalf of the sector as well, how did you think risk was viewed differently on the buy side versus the sell side? Was there a difference? I'm probably fishing for a unique answer here, but look at
the incentives for the sell side are different to the buy side. So there's some sell side analysts are in the business of getting a high ranking by being a subject expert or being an expert on a subject area. So matter expert, how you'd want to describe it. And that is basically being like a consultant of knowledge in that industry. There's some that are in the business of generating stories to be able to create flow, because one of the ways that the P&L of a sell-side firm works from is commission times frequency of trading. So they have a vested interest in whipping up interest or concerns and to stimulate greed and fear. I mean, that reminds me, when I went to the buy side, there was a particular great sell-side salesperson that called me out literally my first day in the office, and he said, "Robert, I just want to welcome you to GLG, and I just want you to know my job is to exploit your greed and your fear." And I thought that absolutely perfectly summed it up. But he was very honest to tell me what his incentives were. So I think you need to understand that the business model of the sell side to get number one rankings can fuel a consultancy type of mentality. To fuel commission generation, it's about maybe exploiting greed and fear. And then there are people who genuinely express their view of what they really think is their best judgment. So I think a judgment of risk, as you described it, I'm more interested in thinking about what is the incentive of the sell side versus the incentives of the buy side, because that can express itself through a different view on a stock.
Yeah.
Because their incentives are different than yours, and therefore their perception of risk can be different.
Now, during your introduction, Ali mentioned that you've basically built sections of Schroders' business, notably Helix. So could you just talk to us about that? What was that like? And then, the floor's yours.
So in my roles at GLG, Soros and Broma, I was a portfolio manager within a fund. And for example, at GLG, I was also the co-manager of the European Long Short Fund. And which had a slightly different responsibility because you were sort of managing overall allocations and risk, but as well as running your own sleeve. So in that environment, you lived and died by the success of your sleeve, your stock selection, your risk taking, your risk management, etc. And that's very exciting. But it also is wary. It wears you down because you're carrying a lot of risk, not just within the day of the market, but over extended periods. And the markets don't close when you go home. The futures market is always open, and news flow never stops. But I believe very fundamentally in the benefits of multi-sleeve manager products because of the benefit of diversification, more so necessarily than single manager strategies, because there are a few very, very successful and impressive single manager strategies, and to name one, for example, on the Gaia platform at Schroders would be, say, Edgerton or Contour, where those are single manager products, but they tend to be the exception, not the norm, where the longevity of that process has persisted and delivered over a very extended period. But the strength of multi-sleeve is that you're not dependent upon any one single manager within the fund, and you have the benefit of diversification, but also they're structured to have low exposure to the market, so a low net delta. So you're not being moved around by the trends in the market to a great extent. So you can deliver through time low correlated returns to the broader market and grind out solid returns. So it was an opportunity to move from being a single sleeve manager to building with great people and great colleagues a multi-sleeve product which would provide stable, low volatility, grinding returns, which in isolation may not be super exciting, but over a cumulative period are very solid and help offset drawdowns in other assets when markets can behave quite volatile. So it was an opportunity to build that, but also do it in an institution that I'd previously worked in and had high respect for, but also an institution which had a lot of centres of excellence with a lot of good quality fund managers inside it that we could work with to build a multi-sleeve market neutral hedge fund. So that was the project, and to a great extent it came through.
Yeah, and I think that makes sense as well, because of course, given how renowned the hedge fund market is, a lot of clients will be looking towards that, but then the whole multi-sleeve idea being, I guess, a lower risk and more consistent opportunity, would you say, from a client's perspective, I think it does make sense. Now, of course, during the intro, Ali also mentioned that the platform called Gaia. So could you just talk about that, and then, of course, the different projects you worked on throughout your career, and how do they differ with each other?
So in addition to building and launching Helix, which came also with a seed from the parent company of Schroders, which in itself was interesting because that was the biggest seed that the firm had made to an internal equity strategy, which was sizable at the time, about $200 million. We also then managed as a team the Gaia platform, and the Gaia platform is a platform which investors, clients of Schroders can have access to a variety of different hedge funds. So these hedge funds normally are sitting in offshore structures, so that's outside the regulated structure of Europe, in the Cayman, for example. Yeah. And the problem with those strategies is they often tend to be closed if they're successful good ones. The liquidity is low, you have to wait a month or sometimes 3 months to be able to get your money in or get your money out. And there is an appetite in a more regulated European market to have more higher frequency trading, more liquid strategies. And Gaia was a platform which allowed strategies in the offshore community, whether that be a Wellington strategy or an Edgerton strategy or a Two Sigma strategy, and bring that into a UCITS format. So it met the UCITS rules, and it also met the liquidity requirements of investors and gave investors access to those products, which they would otherwise not. So it provided not just exposure to experienced managers, but also a different type of return stream that you were used to because of the hedging structure in them. And the platform in aggregate has about 6 billion under management, and in the last year, 2 years, it's been an upward trend of AUM, which is good to see. Alternatives, which is another way of describing hedge funds, have been lackluster from an AUM point of view over the last few years, maybe 4 to 5 years particularly. And in the round, that's been for two reasons. One is that equity markets have been on a tear, so it's just been easier just to be exposed to the equity market through index ETFs. And secondly, with interest rates high, you've been able to get a reasonable return of just putting your money in the bank. So from a diversification hedging point of view, you could just own money in the bank, or you could own gilts or treasuries, and you've tended to be rewarded for that reasonably, supplemented by some high beta exposure to the equity market. But as we see the market becoming more choppy and a lot more rotation within the market, there is an increasing interest potentially in hedge funds to provide that performance that will be different to the broader market because it's diversified, it's hedged, it's got some shorts as well, and its return stream can offset those drawdowns in the bigger market. So there's been increasing interest. So the Gaia platform provides clients access to a number of market-leading players in that space with proven historical track records. So that was an interesting project to work on and to help build alongside the Helix project. As a spin-off on all the work that we did in appraising all the managers inside Schroders, then one's developed a lot of interesting data and analysis in terms of ranking managers, as well as looking at risk windows that are supplementary to conventional risk tools. So there's been a lot of projects going on in the background. So again, always learning, always curious.
Yeah. And I'm sure that translated to the way you dealt with your team and with clients and with fellow managers as well. And I think the final section on this space, and on this section, the final question on this section is what I meant to say. Final question on this section about this space. So if it's okay to say, you're taking a slight step back from the space. So in what ways do you think the liquid alternative space is going to evolve?
Well, that's a simple question with a very complex answer. Look, I think everything depends upon performance.
Yeah.
So the appetite for liquid alts will be conditional on the performance.
Okay.
And there's two sources of performance that they're going to be judged by. One is, do they provide diversification? So, when the proverbial happens or the balloon goes up, whichever expression you want to use, and the broader market struggles, do they actually preserve capital?
Yeah.
Do they actually go up in absolute terms in those periods? And if they do, then great, that's a great starting point, that's a tick in the box. Through time, even if you believe in a bottom left, top right trend in equity markets, because equity markets tend to trend with growing earnings, and if we believe in GDP expansion, then earnings will grow. If they deliver steady growth, not necessarily the same magnitude as the broad equity market, but they provide steady growth with a low volatility, so on a risk-adjusted basis it looks attractive, then they will not just satisfy a diversification need, they'll satisfy a steady capital growth requirement. So as long as the performance is there, the appetite for them and the need for them is clearly there, especially if we are going to be in a world where we've increasingly become inclined to be in, where fiscal imprudence at a government level causes deficits to stay higher for longer, then bond markets are going to struggle to feel comfortable about that, and rates are going to stay higher for treasuries, whether it be 10-year, 20-year, 30-year treasuries. And if rates have to stay high because of the fiscal uncertainty or because of the time premium risk, then you're not going to get rewarded necessarily by owning treasuries in those type of environments where there's a sell-off because of uncertainty around government spending. And that's an issue, potentially around the great big beautiful bill that Trump has put in place, which is, will there be a fiscal event on the back of that at some point? And in that environment, maybe treasuries don't provide the defensiveness and liquid alternatives can and do. There are other people who will argue for illiquid alternatives, so that's private assets, so that's private companies, or that may be infrastructure, and they have their attractions, but they are, by definition, what they say on the tin, they're liquid, so you can't get in and out of them that easily. So they might provide you with theoretical stability to your portfolio, but you don't really know what the market price is because there is no high liquidity around them.
Yeah, brilliant answer. And I went to the Alternative Investments Conference earlier this year, and hearing from other stalwarts in the field like Jonathan Levine and Boaz Weinstein, etc. And I just love seeing the alternative space, something I'm interested in. So hearing what stalwarts like yourself think about the space evolving is very interesting. So for our listeners and viewers, you're probably wondering that we've discussed Robert's career, of course, and we haven't mentioned the lessons from multiple Black Swan events, from multiple crises, and we have saved, as they say, the best till last. And so we're going to go on to a sort of threefold section: macro regimes, crisis lessons, and just market reflections as a whole. So I'm going to kick off with the first question. So you've seen pretty much every major market event of the last 40 years, and I said it at the top of the episode, and there's been loads, and we've missed a few, we've seen a few, right, being only almost 20 years old. But which ones do you believe shaped you the most over your career?
I think the GFC, so the global financial crisis, or Lehman's, would be right up there.
Yeah.
And I think the sovereign crisis in Europe around, particularly Greece, were very significant events. And China too, China's had its crisis in terms of its property cycle. On one hand, it was able to rebound from the GFC with the benefit of helicopter money and fiscal spending and massive surge of economic activity, but it created a bubble for itself around property. So I'd say that those probably stood out the most. Then, as I think about your question, having said that, the fact that I've been on the ground and seen excess inventory build in housing markets in California or in Thailand, which just told you that if there was sluggishness in demand, there would be an implosion of prices because there would be too much supply. It gave you a really real-world hands-on experience, which therefore allowed you to see the problems that the US was going to have in 07 going into 08. Yeah. So I wasn't surprised by the deterioration that was going to come through in the property market in the US, having had that experience back in the sovereign savings and loan crisis and seeing the UK property market crisis. What I didn't have an edge on, what I didn't have a skill set in, was understanding how that would play through to the banking sector, because that wasn't my area of specialization. There were people in the team who had that area of specialization, and the PM and sector specialist on the financials called it absolutely right. Yes, he was a bit early in 06, 07, worrying about it. And in the hedge fund land, being 1 month too early can be the end of a career. But he was intellectually and in practical terms spot on. But I would say that the property crisis that I'd seen on a small scale in the UK, California and Thailand gave you a really clear roadmap for what was going wrong in the US and the inappropriate lending that was going on in terms of zero docs or zero doc requirement for lending, and the inappropriate leverage that people were taking on and the excessive housing stock expansion. You could see that crisis coming. How it played through into the economy you could understand, and my experience taught me that. But what I didn't fully appreciate was all the things that were going to then blow up in terms of balance sheets on banks. Others were able to utilize that. So I'd say that's probably been, when I think back, that's probably been the most impactful experience.
Yeah, that is really interesting. And now, of course, we've got us and our peers, maybe a few analysts who watch these episodes, they'll be going into, and possibly in the future, they'll be, I guess, involved in different market crises. So, for example, the US debt, of course, tariffs could be seen as a bit more minor, but then how would you say someone...
It could have become worse than it has become.
Yeah.
I mean, it started off pretty scary.
Yeah, I mean, sure.
It's kind
Maybe
of
there was method in the madness, but it was certainly scary at first.
When he held up that board, I think everyone was, kind of shivering in their seats.
Again, people say that was mainly negotiation, but my question was that how would someone say adaptable in such market conditions? And I guess.
I think the most important thing is not to be inflexible, not be stuck to a view. You have to deal with the facts in front of you, and in sporting terms, where the ball is there and then.
Yeah.
Not where you want it to be.
Yeah.
That's simple as that. To be honest, it's adaptability is something. And as students, it's hard to develop that.
We can spend time going into detail, but let me just give you one example of detail. So when you're running money, particularly in a leveraged structure like a hedge fund, the way I think about it is think of it like the canvas on a sail. So the more leverage you have out there, the more sail you have. So if suddenly an economic storm comes along, there's a lot of wind and there's a lot of canvas. If you have a strong wind with a lot of sail canvas out, the boat is more likely to tip over. What do? You shrink the canvas, you bring in the sail, you reef the sail, you make the sail smaller so it's less likely to be hit. You turn the boat into the wind, so you make yourself smaller. So you deleverage, you take down your gross, you reduce your positions, you don't become wed to your view on this stock or that stock. You do what you need to do to preserve capital, so you shrink. We can go into lots of other examples of what you do, but so be pragmatic. It is what it is. Cut the risk. Survive for another day.
Yeah, simple as that. Just try and get through it, as you rightfully have across loads of events. We're not going to go into every Black Swan event you've been part of, I assure you, but what's your take on the current macro environment, which we just touched on briefly? Does anything feel worryingly familiar?
I wouldn't say worryingly familiar. What I'd say worryingly reassuring, in the sense that I think the markets are pricing themselves for great execution. No negative friction on global trade on the back of tariffs, and in particularly they're pricing in that there is an imminent benefit from AI in productivity, whilst at the same time we've got headwinds on fiscal issues around certain countries where tax rises may unfortunately be inevitable. I'm thinking of the UK when I say that. And we're hearing and seeing weaker consumer behaviour in the UK, both at a corporate level and a consumer level, because of higher national insurance, uncertainty around taxes coming forward, and those type of conversations around the need to raise taxes in itself is unhelpful because it makes people cautious. And if people become cautious on the margin, it slows down growth. The US, is a very dynamic and attractive economy, but with the market on 22 to 23 times, it's pricing in quite a lot of those virtues. And they may all come through in a nice sequenced way in terms of the benefits of AI and improvement in productivity, and we may have a sufficient cut in interest rates to help the housing market stimulate itself again there. But it's priced not for perfection, but pretty fully priced. Whenever a human being is standing on tilts, when the wind blows, they can rock a bit and fall a bit. So I'm more worried about right now where equity markets are relative to challenges.
Okay, interesting. Do you mind elaborating on that a little bit?
Just that, as I've said, they're pricing in, a lot of excellent execution at the corporate level, the policy level, and history teaches us when multiples are this high, particularly at an extended level of earnings in the cycle, the probability of superior returns being enjoyed 5-10 years out diminish. I would rather have this multiple on the market with depressed earnings currently being experienced, because we're in a cyclical trough with the reacceleration path. The market is enjoying and pricing in very strong earnings growth already. I'm not saying it can't continue, and I'm not saying it can't accelerate, but the probability, unless AI really kicks in with some renewed productivity initiatives, not just for the IT stack, the companies that participate in that, but all the more plain vanilla businesses, whether it be a retailer, whether it be a bank. And I've got no doubt that in time, this AI investment and all these great tools and language models will help with productivity and will help with better client service. So therefore that will reduce costs, that will help margins, and it might stimulate growth. But I'm just not sure about the timing of it, whether it's going to come through quickly enough to satisfy where prices are in the market.
Very interesting.
Yeah, I mean, I remember like at the start of this calendar year, just, you know, reading different, I guess, 2026 looking ahead reports, and it's funny how like the targets set for, I don't know, for example, the S&P and their different indexes, just for a reference, those targets are being met, but then there's just been such a roller coaster in between, hasn't there? So,
well, I mean, on my team, what we spent a lot of time was looking at exactly those expectations on the sell side for the market. We do that at the end of every year, and when you go back to the end of 23, going into 24, there was a lot of caution in the market, and all the sell side were all very cautious, and they were extremely wrong on that view. Then they came into 25 with very strong expectations, very high price targets on the S&P, which they were, a lot of the traveling had already happened between November and December with Trump. And then there was the instability and uncertainty about exactly what the Trump policies would be, and then the market struggled. Then you had the DeepSeek event, which rocked the market because suddenly there was a lot of capital and rating sitting in US exceptionalism and the success of that industry in the stack in the US. And then DeepSeek just reminded people that actually there is competition potentially from China, and that rattled the market. So the brokers all looked extremely wrong-footed. And then we had April the 2nd and the tariffs and the sell-off in the market. And then, sure enough, all the brokers started to revise down their numbers because the goalposts had changed, which is fair, but they had come from a super bullish position to a super bearish position. And then the stock market just did the pain trade and rallied through that. And now all the brokers, as we speak today, are raising their forecasts. I think Goldman Sachs has raised their forecast to 7,100. I'm not sure if it's for a year forward or if it's this year end. And you know, they have a job to do in terms of giving their targets, but they're quite reactive to market events, and I'm not sure they're always necessarily giving you the best guidance of where the markets will be.
Just one last question on this section, which kind of, I think, you know, completes everything that's just been said before, like in other sections as well. So what is your definition of risk, and how has it changed over the years?
Risk is measured, I guess, as a statistician through volatility, the degree to which something swings around, and also the skew of that volatility. Is it more negative than it is positive? And I don't think, you know, we can leave the conversation there. That probably covers. Having said that, you know, risk covers lots of issues. You know, there's positioning risk. So too many people having the same view, coming back to the conversation about the brokers' views on the market. Too many people sitting in the same equity stocks or playing to the same thesis. You know, it might be right, the thesis. The trend of it might be right, but it might already be priced in, and there may be too many people already owning that position. So if something was to change on the margin, the price is driven by the marginal seller versus the marginal buyer, and there's suddenly more sellers because there's too much crowding there. Then the thesis might be right, but the price delivery might be different. So positioning risk is clearly one. Liquidity risk is another form of measure of risk. So, you know, is something easy to trade in and trade out of? You know, it can be like a lobster net. It's easy getting into something, but getting out of it could be more difficult. And then you've got asset class risk, whereby an asset in theory should behave a certain way, and then suddenly it's not doing what it's meant to do, and then that screws up your risk models, and your covariance is suddenly different. So risk you can describe as volatility and the skew and all that, as discussed, but there are many, many things that you need to think about which are where risk is embedded. You know, we could spend hours talking about those, but just, you know, positioning, liquidity, asset risk, overly consensus risk, if there's too much status quo. And the market has a remarkable habit of always exploiting the pain trade, finding where people will hurt the most. And when I've run money, periodically I always feel that it's like the stock market had a perfect view of my book and it knew how to rip the P&L out of it on that day. And it was very, very painful. So the market is always there to humble you.
So yeah, Robert, we've made it to the final section of the episode. So what we normally do is we have 3 questions as promised for each and every one of our guests, because I think it gives, Ali, you agree, of course, it gives a nice overview of yourself, but then what people can really take away from this episode. So question number 1 out of the 3, looking back on your career journey, what are you the most proud of?
I was going to jokingly say surviving. I think being adaptable and thinking, when something you've done your best and you feel that you need to move on because you've done what you can and you've left no stone unturned for your colleagues or whatever, then I think moving on and finding a new challenge is something that I look back on and think has served me well. It wasn't the premeditated intention, but it's looking back, I guess, one of the observations. So the fact that I moved from corporate finance to go closer to the real world of business through equity research, and then going from equity research from the sell side to the buy side, and then from single PM structure to multi-manager structure, I think those have been changes which have kept me stimulated and challenged and fresh. So I think that's one observation, I'd say.
For sure, and I think I was gonna. Sometimes a guest struggles to answer that. Luckily, you haven't. But I was gonna say that if you struggle to answer, I was gonna say adaptability as well. You've seen a lot over your career. Question number 2. Now, we don't like to explicitly give students like ourselves tips, but again, as Naman said, reflection equals tips sometimes and advice. So, if you could give your younger self one piece of advice, and you can completely choose whatever age you'd like, what would it be if you would give any advice?
I think it was Warren Buffett or Charlie Munger or one of those great people that basically said the most important advice is to make sure you choose the right partner for your life. I know that's a cliche, but actually that's very true. Yeah. Because work and everything that goes with that is its own issue, but you need good people in your life around you to keep you humble and focused and not up your own proverbial, keep you real, but also giving you support and giving you motivation. So I think make sure you have great partner in your life and great friends and family. But I would say from a professional perspective, maybe this is not exactly what you asked, but I think when I think back and look at, because I think getting a job is very difficult for people and it's a real challenge. And we just recently hired in our team a charming young lady who I think is extremely capable, who came as an apprentice. And most people come in our team as interns or grads or full-time direct. And she's come as an apprentice and done a stellar job. And I think it's difficult at a young age to have a perfect CV because you haven't got time on your side. But there are a few things that I think, listening to her and talking to others, I think is worth reflecting on. So one is where you have got some work experience, make sure you can maximize on that. 2 is have education experiences outside your own curriculum. So where you've got an interest in, could be investments or it could be in coding, do something about it. Have a society around that. Work with a group of guys and colleagues and friends that where you can show that you have expressed your interest and done something about it. So and also have life experiences which you can talk to. So again, thinking about this apprentice, she worked very hard at school, but she also did ballet in her private time. But that required a lot of dedication, a lot of time, really ridiculously long hours, a lot of physical challenges and leadership and teamwork. So that is interesting to me. And then I think back in my career, there were people who did other unusual things, and it just made for a broad conversation. But for young people trying to break in, supplement your formal education with some interests that match your destination that you're looking to go to, where you've actually taken a practical risk. I mean, you guys doing what you're doing here, I mean, I see that as an example. You know, you're building your profile through these chats. I was happy to help you because I think you've put in the right values and right effort. I don't know whether you're going to go down the financial route or whether you're going to go down the media route, but for you to do this when you're doing your own internships, I think that's good on you. So I think it'll look good on your CV.
Yeah, well, we hope so. And I think genuinely the financial route, this is a passion, but the passion really lies in, well, we started this because we wanted to get jobs in finance. We didn't know how, coming from Peterborough, coming from immigrant backgrounds, right? We didn't know how.
Well, you know, all credit to you for making that effort. So I think, you don't need to ask me that question. You're an example of that answer.
We really do appreciate that. And of course, it's not just us, we've got one of our interns behind the scene right now, and we've got 20 other interns who are working hard for our organisation. So
it sounds like you've got an industry going here.
We're trying.
Yeah, it's a team effort.
For sure.
But final question of the episode then. You've kind of answered it, but I think directly from your story, what's the biggest takeaway you hope our viewers and listeners get?
Biggest takeaway I hope it's not the end of my journey of being curious about markets and being engaged in markets and related matters. Be curious, work hard, have a passion, work with great people, be humble, don't be overly arrogant. Sure, have conviction but don't be. I've made mistakes on the way. I'm sure. There's some people that won't cross the road to say hello to me, but hopefully most people will cross the road to say hello to me, and they're very welcome. But I think be focused, work hard, and be bearable to work with.
For sure, and I think that's a perfect way to end the episode. It's bittersweet because we could genuinely talk for hours, but Rob, I just want to thank you for your time and for opening your doors to us. We really do appreciate it, and of course for our viewers and listeners, we really hope you did enjoy that episode just as much as we did. And of course, thank you to Ritesh Lal, our behind-the-scenes intern, for coming over and helping us out. These in-person episodes are a logistical nightmare, but we love doing it for reasons just like this. So if you are watching us on YouTube and you haven't subscribed already, then please be sure to do so. And I'm sure Robert has given you an amazing reason to subscribe with this 20th episode of the Smart Money Show. And of course, please do follow suit if you're listening to us on audio platforms as well. Drop a like, drop a follow, and drop a comment if there's someone we should be talking to that we haven't spoken to yet, or a topic that we should cover on the show that we haven't covered yet. And please do show us some love and engagement on our social media platform, where our student-led reporting is platformed on our brand new online HQ, aka our website, and of course our events and our tour that hopefully we'll be announcing very, very soon. But as usual, thank you so much for watching and listening, and we'll see you next week for another episode of the Smart Money Show.